You know, a lot of familiar faces in the room. It's just humbling, and we're just blessed to be able to serve all you guys. We're going to try to keep it at about an hour, as we usually do. We have a lot to cover. And Darlene, with that, do you have some announcements about 1099 tax forms?
I do. I know everyone is excited to do their taxes, because I'm getting lots of phone calls and lots of emails for 1099. They will be posted on the 12th at TD Ameritrade. Same for Schwab. I noticed today that some of them have started posting, but they will be there no later than the 15th. The first round, that is. So if you're looking for them and you have any problems pulling them down, just holler at me and I'll be happy to get them for you.
And that's the same day at both TD and Schwab?
It is.
Okay. All right. Good.
But they did start posting today.
Okay. Dennis, you want to hit the agenda then? Oh yeah. I know you guys are going to want to take these legal disclosures, message from the lawyers home, and read them. Yeah. Help you go to sleep at night. Debbie has a hard copy for each of you. But with that, Dennis, can you go over the agenda?
Yeah. So we'll start off with what we usually do, just give you a market update on what happened, with markets across the globe in 2019. Show you how our portfolios performed last year as well. Then we're going to cover some common questions we've been getting recently. A few things like, election year stock returns. What happens in election years? The new Secure Act. What kind of impact that may have on you. And at the end, I will very briefly go over in the fourth quarter of last year. We brought out a new client portal. So I'll very briefly go over that. What's available to you on that, how to log in, things like that. And then, like Brian said, we'll do a Q&A at the end.
I'm going to need to get you to help me point, Dennis. What's up on here is, 2019, it was a great year. So we all ought to enjoy it while it lasts. But up here really are all the major indices that we invest in. U.S. stocks did about 31%. We were a little bit behind that with our tilts to value stocks. International stocks, again, we lagged just a little bit with international, but who's upset with a 21.68% rate of return? Hope that's all right. Emerging markets finally delivered last year, 18. Global real estate was the real sleeper. For those of you guys that may or may not have watched it, interest rates just collapsed at the beginning of the year, and that really helped both bonds and real estate. Usually, probably the biggest surprise is on the bond side. The quality bond market in the U.S. did 8.72%. We were able to deliver 11.55, so about 3 percentage points above that, so that's always nice. But I think the interesting thing to note here is that why do we own bonds anyway? Over the long term, they don't make us a lot of money, so they're really a good diversifier against stock declines. Well, did we have stock declines last year? So everything, stocks did great, and bonds did better than I started this gig in '93. I can't remember bonds doing this well. So great returns, I'm glad we were able to capture some of those for you guys. Dennis is going to go over how we did capture those in our actual portfolios, I think.
Yeah, so up here, I know this is a lot of numbers, I'll blow it up, but now we have 21 years of returns net of all fees, since 1999. So I'm just going to blow up here. What you see here on the left is what 4 of our more popular portfolios have done. It did in 2019. You see up here on the top is one of our more conservative 40% stock, 60% bond mixes, did almost 14% last year. So again, one of our more conservative ones. So like Brian said, it is a really good year, and we'll take that. The most aggressive 100% stocks did 25%. Most of you are right around this 60 to 70% stocks. So you had anywhere from 18 to 19% returns in 2019. This one right here just shows the annualized return since 1999, again, net of all fees. And so you see the most conservative one had about a 6%, right at 5.9, 6% return each year. The most aggressive, 8.2. But what we're really proud of is if again, most of you are in this range of 60 to 70% stocks. The 75% had a 6.7% return annually on average. So if you look at the benchmarks, international stocks did 4, the S&P 500 did 6.6. So with 25% less risk in your portfolio, we were able to beat both of those benchmarks. So that's what we're trying to do is get you the returns you're due with the least amount of risk possible.
Hey, Dennis, I'm sorry, go back to that. I didn't hear you talk about fees. Those returns are gross or net of fees?
Net of fees, yeah.
So fees have already been deducted before you see those numbers? Before any of you see any numbers in your financial plans or your performance reports, they're always net of fees.
So I mentioned the S&P 500. We wanted to bring this up. We're seeing something we have not seen before in the S&P 500. So a lot of people bought, I'm going to go buy this S&P 500 index. It's really well diversified. But what you see here are the top 5 companies in the S&P 500 now make up 18% of the index. So it's really concentrated. We didn't even see this in the tech bubble. So this is the first time this has happened. And so what's I'd say is bad. You think you're diversified. Not only is it only 5 stocks, but look at what stocks they are. You've got Apple, Microsoft, Alphabet is Google, so another tech company. You've got Amazon and Facebook. Those are all what?
Tech stocks.
They're all tech stocks. So about 20% of your money is in 5 stocks, all in the same sector. So that's not near the diversification we would want. So on the flip side, this is what's in your portfolio. Right here, these are the top 25 stocks you guys own in your portfolios. These 25 stocks are about, on the stock portion, are only 9% of what you own. So if you think on $1 million portfolio, if we're managing that for you and it's a 50-50 stock bond mix, these 25 stocks are $45,000 of your portfolio. So quite a bit more diversified across. And then more importantly, if you look at, here I'm gonna try not to look back here, hold on. If you look at some of the holdings in there, the American Tower, that's cell phone towers. You've got Visa, Roche is a drug company. You've got Home Depot, you know what that is. Simon Property Group is malls. JP Morgan Banking, Union Pacific Railroad, Exxon's oil and gas. So not only is it across more stocks, but different sectors. And so one bad news on a sector or a stock isn't going to derail your plan. So the main thing is we're not making any big bets here on this. So speaking of bets, who remembers this last year? We were sitting here a year ago at this, and we were talking about Qatar was the only country that had a positive return across the whole world last year.
Well, if I might interject, the whole idea was, we read in the media all the time. We think this is going up or that's going up. Do they really know? Unless they have a crystal ball and can predict the future. I don't know. All we know really is what's gone up. So that was the point of this, but I'm sorry, Dennis.
No, that's fine. And we kind of kidded about, hey, who wants to load up all your money and let's go put it all on Qatar? Do you want to do that? And we didn't get any takers on it. But so who in here thinks Qatar was the #1 performing country again last year? Anyone? Yeah, you're right. No one.
It was the #1 performer in 18. So did it keep going up and repeat in 19?
What's a 10-year cycle? That's what you keep looking at.
Yeah,
exactly.
It did not. The answer is no, it didn't.
Yeah, because everything always cycles. So that's a good point, John.
Yeah, that's right. So we're going to do this again. So look at all the countries up here, all these markets. Who can guess which one was #1 in 2019?
Wait, the first one to guess who's the top performer in 19 is going to get a little giveaway. I think a
$50 gift card to Amazon.
Does it have to be up there now?
USA now.
It doesn't have to be up there now. Of any country in the world, what was the #1 performing stock market?
No.
I'm sorry, I'm just teasing.
No.
Close.
How about China?
No.
Australia.
No.
Let me get, in spite of what's been talked about in the political arena, it was not the United States. That's the first hint.
India.
It's a pretty small country.
Indonesia?
It's a place that has a lot of sun and people like to go there.
Oh, I think I know that. Belize.
Oh, who?
Who?
Did someone say Greece? Who said it? All right, that's it.
Jenny Noka.
Oh, wow.
And if you look at this was 2018. It was second to last in 2018.
Jenny, you would win that with the tan going on.
Yeah, so Greece was second to last in 2018. Here's 2019. It had a 57% return.
And let's not forget that, 6 or 7 years ago, Greece was going to go bankrupt and take down the entire,
It'll take down everyone,
so.
yeah.
What happened that it went that way?
They must not have made any payments.
Markets are the cycles always cycle. I mean, they went through some bad times, and I guess it got a little bit better. But I don't know how much better it got. It can only get just a little, even if it was really bad. This is another thing we're going to talk about, is markets are always pricing in, not just fundamentals, not just as a company making money, not just as a country doing well, but is it doing better or worse than all market participants expect? You've read in the paper where a company or a country could be doing very poorly, but if they did just a little bit better than the poorest of the poor, their stock can go through the roof. Yeah, so it...
Yeah. To finish that up, though, we talk about Qatar. So Greece was second to last, went to first. Qatar was first and went fourth to the last. So they completely switched. And so that goes, kind of talks about, or shows you why we talk about diversifying across different asset classes and countries and sectors and things like that, because you chase the winner, you're going to get hurt. So to wrap it up, showed you the top 25 holdings. On the stock side, this is your portfolio. This is what you own. So you own 14,255 stocks in almost 50 countries. So again, bad news of a stock or a sector or something like that is not going to derail the financial plan we've done for you and make the whole plan change based on that.
Okay, I'm a little lost. You guys know I'm a nerd, and I lost my little pointer thing, so I'm going to be... So this slide talks about kind of it was the best of times, the worst of times, the Charles Dickens thing. And if you were a U.S. stock investor, or at least if you were an investor in large cap growth or tech stocks, and you studied the past 20 years, you might kind of feel a little bit like, well, it was the best of times for a part of that, and then it kind of got to be the worst of times. But with U.S. stocks, the worst of times came first. Because you see over here on the far left, the S&P 500, and this is not about beating up the S&P 500, it's just about looking at things over a longer perspective. But those that were invested in nothing but large cap, blue chip, U.S. stocks, the way we were all sort of, that's what kind of the media and the big brokerage firms tell you to do. Just buy nothing but blue chips, big dividend paying blue chips, and you'll be fine. Well, that didn't really happen so well in the 2000s, because those people that followed that advice and did nothing but large cap growth stocks, the darlings of Wall Street, over that period of time got a whopping negative return. But if we look back at some of these other areas, and we didn't just limit ourselves to large cap growth stocks in the United States of America, we go and buy maybe some value stocks. Those are like, REITs were some real value plays there. Other dividend-paying stocks, they weren't all the dot-coms that were going through the roof, as you remember. In 88 and 89 and 98 and 99 and so on and so forth. Small caps did well. International stocks, believe it or not, did very well. Emerging market stocks. So a lot of you people in the room are probably getting pretty tired of the lackluster performance of emerging market stocks. But what they did back when we really needed them to perform is they did their job. So those of us that stayed globally diversified, I don't know of anyone in the room that was an aligned client from 2001 to 2010 that actually had the experience of a lost decade. You just didn't. I haven't read one of those reports where that happened. So, and that was just because we just stuck to our diversified strategy through thick and thin. We never really drank the Kool-Aid on the internet. These things are going to go through the roof, so we weren't there when the bubble burst either.
No Munder Net Fund?
No Munder, no Janus 20 Fund, none of that stuff. So go to the next. So that was the worst of times. Now the best of times for large cap U.S. stock investors came during the 10 years that we just experienced. Nothing could touch large cap growth stocks, as Dennis mentioned before, especially tech stocks. They've grown to be the largest constituents of the S&P 500 because they've just done so well. And again, if you look over here to the right, it's not too shabby with large cap value stocks. They weren't that far behind. Small cap stocks, surprisingly, actually over the whole decade did pretty well, but you know, international and emerging, so on and so forth, they didn't put up stellar returns, but look, 7.5 for international beats a -1. I don't care if you're calling it blue chip US or not. 7.5 beats -1 every day in our book of delivering returns to y'all. But if we take and we look at both of these decades tied together, what we see is that now we see each of the asset classes is sort of smoothed out. Some of them cycled up, some of them cycled down, but it was a long enough period of time to where everything kind of smoothed out. And I think what Dennis put in here is that green, and that green line is the return net of fees on a lines managed stock portion. I don't know if there's anyone in the room that has 100% stocks, but whatever you have in stocks, that return 8.2% over that 20-year period net of fees. And I sort of was reading that over the past couple of days. You guys know I sort of like to use analogies, and sometimes they're appropriate and sometimes they're not. But often we use this baseball analogy of we're not even trying to hit home runs. Greatest home run hitter, one of them, Babe Ruth, struck out as much as anyone else. Well, we don't try to hit any home runs because we don't want to strike out with your hard-earned money. I mean, our promise is we're going to deliver solid returns to you that'll help you meet your cash flow needs for the balance of your life and minimize your risk and your cost and your tax. And I think that that's what that green line sort of, in my mind, I don't know about your mind, but that kind of documents that has turned out to be true for the past 20 years. So thanks for your patience, those of you in the room that actually are around to capture those returns, but that's kind of the, Dennis came up with these, I don't know, what do you call these, memes or mimes or cartoons?
Jiffies, GIFs.
He told me the other night, he's like, he's like, Brian, go in and look at the last presentation called Kickoff Report Giphy. And I'm like, well, what's a Giphy? I know everyone in the room gets bored when I sit up here and talk about 10-year past returns and 20, I can see you, Claude, going, well, I may not have 10 years. Well, you get to the point. What's going to happen the next 10 years? And that's what everybody wants to know. So
Jumping up and down.
yeah, right.
Yeah, doing something.
Predicting what's going to happen with any degree of precision in the financial markets, especially the stock markets, is a daunting task. There's not too many people, but we are going to go on record. I think this might be the first time you guys for making some. You can call them predictions if you want. We feel like it's better to maybe prepare than try to predict. But some of these preparations are along the lines of, I mean, we've got some pretty strong convictions. The first one is kind of the obvious. The first prediction that I'll go on record right now, markets are going to continue to fluctuate. I'm not going too far out, and I don't think too many of you guys are going to have a hard time believing that.
Mark it down.
But I think that we forget, especially after a year like this year, when returns were so steady, really, for most of the year, and ended up so nice that we forget, and over on the right-hand side, I'm going to need to get you to help me out there. If you'll just focus, and this goes back to the 1930s, so this is a pretty long and maybe pretty meaningful data set, and you guys know how much we love to try to learn what we can from data. But if you go back to 1930, there's never been a decade when we haven't had, when we've had more than 30% of the time that we had only single-digit returns, either to the upside or the downside. It's always, I don't think we move from one period of uncertainty into the next period of certainty. It's like we move from one period of uncertainty to what's next, and that's another period of uncertainty, and all we can do is the best we can do with where the ball lies now in the new environment.
But I wasn't born in 1930, believe it or not. But that's all my parents talked about was, what was that called, the Great Depression, and and then of course the war in 1940 and so on, and how poor they were. So how could those stocks have been doing pretty well?
Well, I think a lot of people did you know, a lot of people did panic, and here's sort of the rule that I try to live by, and it's a hard rule to live by when things get crappy. And look, I wasn't around in the Depression.
No, I know you.
But I was around from 2007 to 2008, and I've done quite a bit of study about the Depression. And I think that anyone that held on to a diversified stock portfolio, in fact, did not lose money in the Depression. Only the folks that sold. Now, that might have been a difficult thing to do, and I know that jobs were hard to come by, and I'm a young guy, and maybe I don't know what I'm talking about. But no panic, no sell, no sell, no lose is the mantra that we follow, and it's worked through thick and thin through all these decades if you gave it enough time. That's why it's so important that everybody in the room understand where is your income going to come from over the next 6 months, over the next 6 years, over the next 7 years, whatever's going to make you. Certainly, we never want to put somebody into a financial plan where you don't know where we don't have your income coming from cash, short-term securities, very high-quality corporates, maybe on out to 5 years at a minimum before you go putting any money in the stock market.
Oh, yeah.
Because we don't know where the stock market's going to be in 5 years. And if we plan out those cash flows, a lot of times that allows the plan to really, I'm not going to say the next time we go into a major bear market, which we will, you're not going to, a lot of us are going to be nervous and we're going to have stomach aches. But if we're able to, that's when we'd really encourage you to get in and let's look at, okay, wizards, show us where the cash flow is going to come from now that we've watched, 10, 15, 20% of our portfolio disappear. What are we going to live on to continue our lifestyle for the next, until this recovers? And I think we've been able to do that over the years, or at least I hope we have. That's part of our job. So the next prediction that I'll go on record making is that I think it's very likely that bond returns last year, boy, those were nice, but bond returns in the future I think are very likely to be much lower, if not much lower, than in the past. I mean, don't shoot the messenger. You guys know that the way Dennis and I work, he's always the good guy. It's good cop, bad cop, and I always got to talk about the But I think it's really unlikely that unless we go way far out on a bond's maturity, or we go way far down and buy junk bonds, it's going to be really hard to make a decent interest rate in bonds going forward. And the reason I say what I did was we went back 50 years, and you can see this decade by decade, the 10s, 2000s, 1990s, 1980s, 1970s. The stock market is very difficult to predict for many reasons, but it is based a lot on fundamentals like how much does it cost me to buy $1 in earnings, or how much does it cost me to buy $1 in book value, and all those nerdy things. But the stock market is very made up of expectations, and that has to do with people's feelings. I can't figure out people's feelings tomorrow or next week, much less over the next 5 or 10 years. But bonds are not really that way. I mean, especially if you're dealing with high quality bonds like treasuries, the fact of the matter is that the current yield usually will tell you what you're going to earn on those bonds. So right here we're looking at 5-year treasuries. And you can see that the starting yield in each decade, it wasn't perfect because the bond markets are fluid and they'll fluctuate with changes in interest rates. But look how close, the 70s, starting yield at 8. I mean, who would love to have an 8% return on a 5-year treasury right now? I mean, load the boat. Load the boat and put Dennis and Brian out of a job. I mean, but you look at that and you see 8% ended up at 7%. You can see how close, and those annual returns are the 10 years returns after those beginning yields, you guys. So you see how close they are. So the starting yield is usually a very good predictor of what you're going to earn on any given bond over, or at least on high quality bonds over the next 5 or 10 years. Everybody with me so far? So, why do I say bond returns will be lower? Well, you can see the trend and you know the trend. You go out and buy a 6-month CD and you take the average rate, it's 0.75. It's 0.75%. That's not going to get it. That's not going to get it done. Today, the 5-year Treasury, I looked it up yesterday, it was 1.35. So even where it started in 10 at 2.3, this is a sad statement. 2.3 looks pretty good to 1.35 though, of the 5-year Treasury. The 10-year is going to give you 1.5 today. You can loan your money out for 30 years and get a paltry 2%, a little bit less than 2%. So, I mean, I just think we need to get prepared for, and we're going to do everything. I mean, we show up every day and try to scratch every basis point and every percentage point out that we can for you guys without subjecting you to ridiculous risk. And maybe we do need to go down a little bit in credit if the spreads between very high quality and a little bit lower quality bonds is right. And this is what we did, if you remember on the first page when we talked about the bond returns last year being 11.5 and the overall bond market was 8.5. Well, we went down a little bit in credit quality because we were getting paid for that. I'm not talking about going into junk. I'm just talking about going down from AAA to maybe, you know, A or triple B. I don't know how far we got, but I think on average it's double A. It's not like we have any junk. The other thing that we did is we would go longer or shorter if going longer bought us, you know, a higher than average yield between the long bonds and the short bonds. So, but there's only so much you can do. I mean, we're at very low interest rates, and more than half of the central banks are targeting negative interest rates. That's the world we live in. Yeah. And I don't think I'm telling you guys anything you don't already know, but that's the landscape. So with those two things combined, we've got volatile stocks. They've always been and they always will be in our humble opinion. And we got very, very low interest rates. The only way that we're going to be able to make any kind of return over and above the cost of living is to just try to get used to volatility in the portfolio without it, you know, giving you too much stomach ache or keeping you from sleeping at night is really because what's normal on the next slide, you know, is that we're not going to be able to get what we got. I don't think. I hope we do. I hope we get another 2019 year in and year out. I just don't think. That's not very likely if history's any guide. What's more normal is this. So, with really low interest rates and volatile stocks, we got to be smarter about how we allocate assets. We just do. And anyone who tells you that they can get you a rate of return way over and above the inflation rate without any volatility, I don't know. I'd go find my best running shoes probably. I mean, I just don't think it's, I don't know that it's doable. But we can combine all these asset classes and maybe deliver a return that is going to get the job done. I don't know what's next. Oh yeah, so here's my third prediction. Is that the Armageddonists will be out in droves, and maybe they always have been, but no, I really noticed this. And what am I talking about? You know, after 2010, there were all these real smart-sounding guys, and somebody pointed out, I said guys and girls when I was going, and Laura said, well, actually, Brian, there aren't any girls up here. It's only guys. So. They're the wrong ones. But they're all pretty smart sounding. I call them the RSSGs, the real smart sounding guys. So all these Armageddonists, you know, and they come out, you may or may not have remembered. I know this is very hard to read, but we took like 17 pretty famous Armageddonists. And I think you guys pretty much know the characters we're talking about. They come on CNBC and they say, well, the first guy up there, Rubini, he's a, NYU professor at the Stern School of Business, and he sounds very smart, and he is very smart. What's interesting to me about Rubini, and this isn't to beat up on him, but I remember back in the financial crisis, he went over this same thing, that they're going down, they're never coming back, get out, they're not coming back in your lifetime. Just get out. And then I don't know, 2 days later they were he's a media hound, and so he gets up there and they ask him, well, we heard what you said, get out and don't come back. Dr. Rubini, what are you doing with your own portfolio? Well, I own 100% stocks because over the long run, they always work. So, whatever you want to do with that kind of advice, but, and you think about it, and it's not surprising because as we go back to people that own nothing but the S&P 500, remember, they didn't make any money for the previous 10 years. They were susceptible to this kind of messaging, especially after they lost some of them lost a lot of money in the tech wreck, lost a lot of money in the financial crisis. And so then somebody comes along and says, well, it's going to happen again, you better get out. That's kind of a compelling message. It also sells advertising. We as human beings, whether we like it or not, and the media knows it, and the media wants to sell magazines and newspapers and ads, and the fact of the matter is that good news don't sell. It's got to be bad. And the worse it is, the better it sells, and you can see it going on right now with the coronavirus. I'm not saying, and I'm not a infectious disease expert, and neither is anyone. I don't know how bad that is going to get, but you're already seeing these kind of Armageddonist comments. But I will tell you this, that we're not interested in what works. We're not really interested in what makes us sound smart. We're interested in, we are interested in what works. We are not interested in what sounds smart or looks smart. Obviously, we don't sell magazines or anything like that. So let's take a look at what works. Did this work if you listen to these dire predictions of the Armageddonists? And that is a picture of the ride that you would have experienced had just one of these scared you out of stocks and into bonds, and you're like, I'm done with that. I'm done with the market. I had it in the tech thing. I certainly had it in the financial crisis, and honey, I ain't never going back again. Now, I'm not saying that they didn't get more positive later, but what I am saying is a lot of people got scared out of the market because of these types of what I think are rather reckless declarations, and they never came back. And you can just look at what happened. The opportunity costs there are tremendous. Now, to be sure, one day these Armageddonists will be right. As sure as a broken clock tells time correctly twice a day, we're going to get a bear market, and they're going to look smart again, and they're going to go on CNBC and say, I told you so, and so on and so forth. But how much, it's going to have to be a brutal bear market for that to occur. It may happen. I'm not saying it won't happen. But I want you to hold that picture, if you will, in your mind. Everybody got that picture? Does anyone want to go on that ride? I didn't think so. So hold that picture in your mind. Let's take a look at a different picture over the exact same period of time. And that was what our strategy, most of the folks in the room, that is what you experienced over that same period of time. It didn't come without some negative news. It didn't come out you log in your computer and go, well, I'm going to get Brian on the phone right now. I don't care if it is 10:30 at night. Something has got to be wrong here. But the fact of the matter is that I'd much rather take that ride than the one that we saw before. And so a picture sort of paints 1,000 words, I think.
Well, and I'll point out too on this isn't a picture we just made up. So I actually took a snapshot. This is directly from our performance reporting and portfolio management system. So this is the exact same days, and what you see, what it shows here is this is the amount you all invested, and this is what you've got. So it shows in that same time frame, you all in here made almost $92 million in that time frame.
Actually, go back. I want to do sort of a little. How many people have had an eye exam lately? Just to hit this home. Yeah. So let's do that real quick. Do you prefer this? Or do you prefer that? Okay.
A or B?
Do you prefer A, or would you prefer B? So, and all I wanted to point out is that nice blue chart was those returns were delivered. Claude, you know this as well. We weren't picking the best stock. We weren't trying to pick the best market. We weren't trying to pick the next Qatar or when Greece is going to shoot. We weren't, loading up on the hot stock money manager, stock picker guy who's probably taking more risk with your money than you even dream of. We didn't load up on nothing but Warren Buffett. It was all about coming in, running this same. People call it nerdy. People call it guilty as charged. But I think it's worked. It's worked for a long period of time, and it's worked in good and bad times. And we're always trying to, and so those results were achieved with us coming in, running that playbook, staying alert for rebalancing opportunities, staying in touch with you about when you're going to need money and what your cash flow needs are, and just running the plan, running the system, running the plan, running the system. It's there wasn't anything magical to it at all.
Yeah, so the next question we're starting to get now, of course, is, I know a lot of you in here are thinking this, what about election years? We're obviously in one. It's already started. We're seeing a lot of that, the campaigning already. But do elections affect stock market returns? And so you're going to, like Brian said, you're going to start seeing a lot of these Armageddonists. You're going to start seeing crazy headlines. You remember, 4 years ago, as if Trump won, it's going to go down 20%. We're going to start hearing all that. And so what we decided to do is what we always do is just say, okay, well, let's go look and see what the data says. Let's go look at all these different years and see what happens in election years, what's happened over long periods of time, so we can see what to expect. So what this shows is the S&P 500 back to the mid-50s. And on here, the ones with an E are election years. And what it shows is election years are really one of the more stable years we have over the election cycle. And it's really in between. If you look at the circles, that's when we see bigger declines. It's right in the middle of it. You think about 2 years ago in 2018, we saw a 6% decline in the S&P 500. Same thing, and if you kind of think about how it works, it makes sense. So, someone's elected, you kind of want to get the bad news, and you've got a controversial bill you want to pass. You want to get it done quick. You want to get it pushed through and get the bad news out of the way. And that way, by the third and fourth year, things look great. You're up for re-election again. You can talk about how things work. So it really makes sense. So then we took that and said, let's break it down year by year and see what the data shows. And so the light blue is the average. This is going back to 1941. So that's a 79-year time frame. You think about how many, we've been through different wars, we've been through different economic conditions, we've been through Republicans and Democrats, and all kinds of things. Different interest rates. This is about a lot of good data to see what happens over time. And what you see is the first 2 years on average are the worst years in the market. And we saw, the blue is the current election cycle. And so the first year did pretty well, kind of, again, the second year didn't do too well. The third year, by far, on average, is the best year. That's kind of like I talked about. That's when, they're trying to smooth things out, and you don't see many bills going through, and there's not, it's all about getting the economy back on track and things like that. And so, the average is 15.5%. We saw it go up almost 30 last year. So here it is, an election year. The average is just over 6.5%, the third best year on average. And so, I think as of yesterday, we're up a little over 3, I believe, or maybe close to 4 now on it. And so, what it comes down to is, I think a lot of it is because 2000 and 2008 were election years. A lot of people think about that, and they're fearful of election years. But if you look at the last two, I think the one, it was 9 on the last one, then 8 years ago was 13.5%. So they were good years. So the last 2 election years have given you pretty good returns. Who can do this? Who's going to get up and dance?
Yeah. We had to explain to Brian that this was a real dance, and it's called the floss. And I was like,
I want to see a show of hands. Does anyone know what the floss is?
yeah.
Oh, yeah.
So, anyway, so now we're going to talk about everybody's favorite subject, taxes, and the government and their role in our lives. And so, as many of you have heard over the last, you've been reading, especially, since the Act passed, but we've been discussing it over the past year. The Secure Act passed, and it was signed into law on December 20th of 2019. And it became effective January 1st. So it has some pretty important changes that affect people. They have almost 40 rules that affect individuals in different companies. And it affects IRAs, 529 plans, workplace retirement plans, and it has some extenders for the Tax Cut and Jobs Act that was passed in 2018. So there's some pretty significant changes, but we're going to talk just about a few of the changes that will impact the majority of you guys. One of the most common ones, or most talked about ones, was the RMD starting age being pushed back to age 72. I know a lot of people were excited about that. They're not going to force you to take a required minimum distribution at age 70 and a half. They've bumped it back to age 72. What's interesting is that even though it was talked about quite a bit, it only affects about 20% of those who get to that age at 70 and a half. The majority of Americans take their IRA distributions earlier than that to live on, so it really affected only a small percentage. But another good news, and I'm kind of like the good news, bad news person here on the taxes. I'm always a good cop, but I do have good and bad news on the tax side. The other good positive change was traditional IRA contributions. Previously, if you continued working after age 70 and a half, you were prohibited from making traditional IRA contributions. Well, that age limit has been removed, and now if you're 70 and a half and you're continuing to work, you can contribute to an IRA. There's no more age limit. The bad news, and in my opinion, I think this is really bad news, and probably the most under-discussed change that's going to affect everybody, is the death of the stretch. And a lot of people, IRA owners, are using the stretch provision to plan for their families and estate planning. And what that means is that when an IRA owner passes away, the spouse inherits. And so the spouse can extend the IRA distributions over their lifetimes. Well, then when the spouse would pass away, the children would inherit, or sometimes even the grandchildren. And then they could take it over their lifetimes. And that was a great estate planning tool. Well, that's gone. So what the Secure Act did is that you can still transfer to your spouse, and they can take it over their lifetimes, but once both spouses are gone, game over. The Senate changed it to where you have to deplete that account. Any non-spouse beneficiary has to deplete that account by the end of the 10th year. That's the only required minimum distribution, is at the end of the 10th year. So one of the reasons they did that was, of course, taxes, because the death of the stretch is projected to bring in $16 billion in taxes over the next 10 years. And instead of spreading that over even your grandchildren's lifetime, it's going to start happening with the 10-year distributions. So that's a pretty significant change, and I don't think people realize how impactful that's going to be until the non-spouse beneficiaries start paying those taxes, and a lot of them are working and they're at their top tax bracket anyway. And so now you've got this, this distribution coming in, and you're going to have to pay the next level of taxes on it. So it can be pretty burdensome. And it also applies to Roth IRAs. So anything that's an IRA or 401k, it has to be distributed by the end of the 10th year. Okay. Good news. The Secure Act did not change the age that you can make a qualified charitable donation from your IRA. You can still make that at age 70 and a half and just send a payment directly from your IRA to your church or charity of choice. And it's a non-taxable event. You can still offset your distribution by your donation. And it all happens on the front of your tax return. You just, if you send $10,000 to your church from your IRA, even though you're not required to take that money, you can still zero it out as a qualified charitable donation. It's still limited to $100,000 per person annually. Now the other change, well, it didn't change, was the charitable contributions from appreciated investments. So a lot of people would use that before age 70 and a half. If you had a highly appreciated stock or investment holding, you could, in a taxable account or a trust account, taxable, anything that's taxable, you could send that to your church or charity of choice, and by sending it directly, you bypass all capital gain taxes on that distribution, which, sometimes people would sell those and then give the money, but then they're stuck with a capital gains tax bill. And but what I want to make sure everyone understands is that if you contribute from your IRA, that zeroes out your tax liability. If you donate appreciated stock or investments to an organization, that becomes a tax deduction. So they're treated very differently on your tax return. Now, one of the things I would like everyone to consider too is that if you're going to donate appreciated investments to your church or organization, think about the new standard deduction that came along with the Tax Cut and Jobs Act of 2018. So for example, in 2020, a married couple's standard deduction is $24,800. Well, that's going to be your standard deduction. It doesn't zero out your tax liability. So if you're going to consider contributing appreciated investments, think about your standard deduction. If you're taking the standard deduction, there's really not a benefit to you to approach it this way, because donating appreciated stock is a tax planning tool, and if you're taking the standard deduction, it's not a tool anymore.
Unless it's a big amount.
Unless it's a big amount.
Yeah.
So if you're wanting to donate more than $25,000 and you're going to itemize and actually get a benefit, it might be worth it. But just if you have any questions, call us, and we'll discuss what your options are. And we're happy to work with anybody and their CPA and tax attorney as we navigate, because this is a lot, and this was just a very high level overview of the Secure Act and the few impacts it will have on you guys. But if you have any questions, give us a call and we'll help you. Yes, we will.
So another question, if you don't know, in the fourth quarter of last year, Schwab acquired TD Ameritrade. And so, a question we've been getting is, okay, a lot of you here at TD Ameritrade, is that going to affect my accounts? And as Danny DeVito is telling you, no, it's not. And so it's really, it's business as usual. We currently use both Schwab and TD Ameritrade, so we're comfortable with them. I mean, it's not going to change how we do business or anything. They're going to run as separate entities. They're telling us for about 2 to 3 years. And so it'll be, business as usual there, and then at the end they'll just merge and it'll be Schwab. So, if you're at TD Ameritrade, for 2 or 3 years you're going to have a TD Ameritrade statement, and you'll log in there. When it happens, you'll start getting a Schwab statement. So it goes pretty smooth. You don't need to read this, so I can say that with a high degree of certainty, because I just wanted to show you this. This is Charles Schwab on the left, Ameritrade on the right since 1971. One of the reasons I can say that is they've done this 26 times between them. This shows all the acquisitions each of them have done in that time frame. They've done this a lot. And so it's nothing new. It's nothing you really need to be worried about. Another reason I could say that with a high degree of certainty is I've gone through this twice myself. I don't know if you know, I actually worked at this firm here in the middle, which was Waterhouse Securities started in the late 90s. And so it was Waterhouse Securities about 2000, I can't read it either, but about 2000 or so, TD bought Waterhouse, so it became TD Waterhouse. So I went through that acquisition, same thing, it was just, they kind of ran separate for a little while, and then it switched, and you had, statements from TD Waterhouse all of a sudden. And then an interesting note about right here in TD Waterhouse office is where I met Brian. So just kind of a side note. That's how we met. And then here is when Ameritrade acquired TD Waterhouse, which is now TD Ameritrade. So I went through that one as well. So I've gone through it twice. It's really nothing to it. Nothing to be scared of. Business as usual. An interesting note is that when this does happen, your money will be at the 3rd largest brokerage firm in the country now. It's going to be a big firm. And so you see here, it's going to be about $5 trillion in assets. It's bigger than JP Morgan, Morgan Stanley, Bank of America. It's going to be, a big firm. And we think it's going to be, both have them, one's better at this technology than the other, one's better. So, we think it's going to be a good combination. But know this, if it's not, we don't work for any of these firms. We're your fiduciary. And so we're trying to, we're out doing what's best for you guys. And a good example is we actually used to use Fidelity as well. We used TD Ameritrade and Fidelity for a while. And Fidelity came in and said, okay, you're using DFA and Vanguard, and we're not making any money off that. It was $24 a trade there and $24 at Fidelity. And Fidelity said, okay, if you buy our funds, it's free. If you buy those, it's $50. We're going to double your commissions, or the transaction cost on that you guys pay. And so that's when we went over to Schwab and said, no, we're not going to do that. And so that's why we use both of these firms. So we're always paying attention on that, but for us, I think it's going to be a good deal. All right, the new client login. So how many of you have logged into this, the new client login? Yes, a lot of you haven't yet.
How many of you guys have seen this Giphy before?
Again, so yeah, we rolled that out in the fourth quarter. I'm just going to give you a very brief overview on it because there's a lot to it. So tomorrow we're going to send you all an email. It just really breaks it down on if you haven't been in there. Here's how you access it. Here's how you log in. Here's you'll need to create your own password, and when you access it, here's all the options available. So there's all these different things. I'm not going to go over it. And if you have any problems, just call this kid. He knows what he's doing. No, you can call us if you have any problem. So this is the homepage to our new website that we also rolled out at the same time. If you don't know, it's alignmywealth.com. And when you go here, you'll see in the top right corner, there's the client login now. It's just one central link where you go straight into it.
Dennis, you might mention that they need to reset their password if it's the first time they're accessing.
It'll be there's some information, but you'll to kind of tell you when you go in, you'll click forget password, and you'll be able to create your own and everything. So it'll take you through the steps, because if you have not logged into this, that's right. If you're using like if you logged into the performance management system we had before, which this is part of it, but that one directly, it's a different login. So this one's a whole new login, and it lets you access both of them all at once.
Say Yelp.
Do what?
Yelp. Anytime I try these apps, it always kind of goes to Yelp.
Yeah, it's a link to it.
I don't like it.
This isn't, when you log in, this is the top of it. Sorry, I keep stepping in front of you. On the left here, it's going to have a total net worth, and there's a button that says link account. And I'll tell you why. In the middle has that'll show you the amount that we're managing for you in all the accounts. Across, so if we're managing multiple accounts, it'll put them all together. The net worth, if you can see it here, is a little more because you can now link outside accounts to it. So if you have a 401k outside, or bank accounts, or you can even enter manual things like your real estate, home, things like that, so you can see a total net worth in this. And then there's a little what we call financial planning light here. And if we've done a financial plan for you, this does not take place of that. This is just a very simplistic portfolio projection. If you're still in the saving mode, you can slide, what if I retire later, earlier? What if I save more? What if I added some more assets right now? What happens to the portfolio? And it'll go through, and based on how you're invested, it'll show you what that projection, how that changes at the time. So, and if you're in withdrawal mode, then it changes here and says, okay, what if I increase or decrease my withdrawals? Or what if I took a little money out of that, took this chunk out? What happens to the portfolio projection? It'll go through and run it right then, based on exactly how your assets are invested. When you scroll down, there's additional, and this will be in the email. It kind of breaks down your asset allocation, shows we're on target performance. You can really break down the whole net worth statement and see all your accounts, the ones we're managing, the outside accounts, everything. So it kind of compiles everything on one website. And then over here in this little pie chart, and then there's some others, again, underneath it, it'll explain to you. You click on that, and it brings up the one you've always had access to. So this is directly into our portfolio management system, and you can go see all your performance. You can see your holdings, income, everything down to the penny. We're just giving you access to exactly what we see every day and what we're doing. And so if you have any questions about what's available in there, but if you go up in here, there's all kinds of reports you can run, all different time frames, all that. So again, we're just trying to give you all the information, make sure you feel like you're well informed on what's going on. And finally, up here, there's a little tab called Documents, and it's a secure vault. If you need to make sure you go in there every 90 days, we're putting a performance report in there for you, showing here's where you started 90 days ago, here's where you ended, here's what you made or lost, here's what you own. And we're just sending that, and we're putting it right there every 90 days, unless we're mailing it to you. Well, even if we're mailing it to you, we still put it there. So when you log in, you can get that. So again, we'll send an email out, giving you much more detail on it. If you have any questions, don't hesitate to give us a call. We're happy to help you through it. And that's it. What questions do you have?
Do you guys have some kind of matching program? I look at the returns on investment, and I was thinking, well, if you were to get married again, then you got a new spouse. But you can stretch that out a while.
You better watch it. Here, I'm gonna laser point this. You better sit in this seat right here.
The other thing, you guys are such good pickers that if we brought them by and you could beat them, maybe you could decide whether that was the way to go. Because you got a positive return instead of a negative return.
Yeah.
What do you think?
There's not any good ones.
But it does open this whole, death of the stretch, the 72 delay on the RMDs. I mean, there's a window there where you can do quite a lot of pretty decent financial planning. You guys that I've worked with personally know that I've not been a big fan of the Roth IRA, or the Roth conversion anyway. You convert from a regular to a Roth IRA, you got to pay all the tax to go over the bridge from the tax deferred to the tax free. That's a trouble. And but now you might, if you got a big IRA, there's some folks in the room, we might want to analyze that, and we've invested in some technology to help us look at that, to where we can, if you're in a 22% tax bracket right now, and you don't get till the 24 till what, 360,000 for a married couple.
That's about right. Yep.
You got a little bit of room in that bucket, and so you might want to consider. I mean, it's painful, but you might want to consider paying tax
Up to that.
earlier than you have to at 22, rather than maybe risking it at a higher rate later on and converting that to a Roth IRA. Now that assumes that you believe the government's not going to tax the Roth on the way out. You've got to make that leap of faith. I'm not sure I've totally made it yet. You guys know I'm totally transparent, but if they stick, and I think it will be grandfathered in. I mean, I'm not sure about that, but most times when they make a tax law change like that, if you act according to current tax law, you do get grandfathered in. So I do think I do think it'd be a good exercise for those in the room that have sizable IRAs that you would like to leave behind to your kids, even though you'd only have to get it. Even if you do a Roth conversion, this new Secure Act, I call it the Insecure Act, actually.
Yeah.
Secure for the government.
Secure for the government. That's right.
But you might be wise, if that money is sort of inheritance money, not your money, John, to look at some Roth conversions and maybe fill up some lower tax brackets with some Roth conversions now. But you got to really be right. It used to be you could do a Roth conversion. You guys may remember, you could do a Roth conversion, and then if you felt like you screwed it up, you had like a year to do it over. There's none of that anymore. You've got to be right.
Do-overs are gone with the tax.
I would not do it just because a friend did it. I would.
Those were nice too.
Work and have to do the math.
I liked having those do-overs.
Well, the other thing too that we would also consider, because every family's situation is different and very unique, and so we would also look at what's the break-even point on doing a Roth conversion, and what's your non-spouse beneficiary situation. Would it benefit them to go ahead and inherit tax-deferred income and do some planning for them? So we're looking at different ways, but again, everybody's situation is different.
Completely.
So, we're still trying to figure out how to minimize taxes on this and figure out how to pass it along in the most efficient way.
Question? With the new rules on IRA contributions after age 70 and a half, the Secure Act, what are the other limitations that would prevent you from making a contribution after that age?
Well, the income limits, I believe.
Yeah,
the income limits.
You can always make one. Are you talking about it?
But
if it's deductible or
If
not.
it's deductible or not.
But you can always make one.
But the same limits that were always in place, on earned income, those are still there. So that
that what
has
you're
not
asking?
changed.
Well, if you get to above a certain income level, you can't contribute.
You can, but it phases out.
If you don't have earned income, you can't contribute.
Yeah, if you don't have earned income, you can't.
That's all correct.
Yeah.
Right.
But
Yeah.
stuff like you might consider we need to look at your case. I mean,
Yeah.
I know you got IRAs, but you might contribute to a non-deductible IRA and
Right.
then maybe convert that to a Roth. Now, we need to be careful, because I know you got other IRAs.
Yeah, we probably wouldn't want to do that.
This is,
Yeah.
I think it is a negative law, but it does kind of prompt us to maybe get creative with some tax planning that might be beneficial under the new rules.
And not to frighten anybody, but like Brian was talking about, if the Senate or any of the committees are discussing like taxing Roth accounts or somehow figuring out a way to get money from them or change the rules, going back to the 10-year stretch, the Senate considered that starting in 2012, and they only talked about doing a 5-year window to withdraw everything. So, the fact that we have 10 years, I thought, well, that feels pretty good now, considering they initially talked about just doing a 5-year window to withdraw the entire, so if you had like a, $2 million IRA and you left it to one child, I mean, in 5 years, that had to be emptied. And look at the tax bill to that non-spouse beneficiary. So, they talk about it behind the doors, behind closed doors for a long time, and then all of a sudden it's law. Yeah.
I would follow it up with, you and I have talked about this a lot. I mean, the government will try to, a few years ago they tried to scare people into doing Roth conversions, saying that, well, if you make too much, you couldn't do them, and then all of a sudden, no matter how much you make, you can do Roth conversions. It was kind of this promotion of Roth conversions, because they get tax dollars off of it. And the people that rushed into that, I'm not sure. I mean, I wouldn't rush into Roth conversions. You're going to pay tax early. It's always worked to defer tax and defer tax and defer tax. But it does make you think. If you've got, you got so many years and you got a big IRA.
Yeah.
It's something to seriously run the math on, I think, and consider.
Yeah,
And you don't have to do it all at once.
As I say, when we did a lot of them, at that time, if you're in the same tax bracket, it took like 30 years for it to make sense.
Break even.
Because you're paying that tax up front. So to get that break even, it was 25, 30 years. And then after that, it was a good idea. And so the only time we really start thinking about it is if you're, like Brian said, you're in a 22 or 24% tax bracket, and 5 years from now, you're going to go to 35 or 32 or something like that. Well, maybe we at least go pay quite a bit less right now and get it moved over to a Roth. So.
Yeah, I think, what about the situation where 5 years from now we're paying 50% tax?
Yeah. Could happen.
You do that and you trust the government, well, with that statement, you probably don't. But if you do that, you trust the government not to tax the Roth withdrawals, a Roth conversion would look like a home run.
Yeah.
If there's a big downturn in the market,
that's the time.
That's the time to do it. Yep.
That's we did some of those back in the financial crisis, and those turned out to be really good in hindsight.
Especially certain positions. Yeah, if they fall a lot, you can move that position while it's down. That's a good point.
Nobody likes to have a position that's greater, but that's a way to turn a lemon into lemonade.
Yeah.
I don't know what would happen. I think a lot of us in the room, maybe, I don't know, everybody, you get a Roth and a regular IRA, let's say. And, you've got income that you're receiving. Maybe you should balance withdrawals to keep your AGI lower as you go down the road to avoid higher
That's exactly right.
insurance costs.
Yep. That's right.
To avoid higher Medicare costs.
That's right.
You call that what you want, insurance premiums or taxes. Kind of the same.
Same thing. Yeah.
So you can project how much money you withdraw, and that's the only source of income. Then maybe these guys and me and everybody would like to, okay, where's the sweet spot?
Right.
And that's what this is all about, really, John.
Find that sweet spot. Yeah.
There's
exactly
not
right.
a perfect plan for anybody. It's kind of looking at you, your situation, where your money is, what your spending needs are, what your goals are, what your tax, managing that tax bracket is really key, because it's tied to so many things. It's not tied just to taxes. As Mr. Yarberry just said, it can affect, everyone in there probably knows, it really can affect your Medicare premiums big time. So,
Laura's going to be busy.
I'm sorry?
Laura's going to be busy.
Yeah, you
I would
offered.
be very busy, yeah. But I think going back to, the income affects more than just your taxes, and it's, it does affect your Social Security premium or Medicare premiums. And so I do think this does give us a little bit breather for those that are transitioning, who are not 70 yet or 70 and a half. that will have that 72 RMD age. So, but on Social Security, you're required to take it at age 70, or you're not required, but there's no more benefit to delaying it.
Yeah.
So if you're waiting till 70 to take Social Security and all of a sudden you're having to take RMDs, then that could have thrown a lot of people into the next, high tax bracket, and all of a sudden you're subject to the IRMA, on the Medicare premium. So there's a lot to consider, but I think with, RMDs at age 72, that kind of gives a little bit more breathing room to do tax planning and how to keep Medicare premiums down, especially if it's somebody who's working into their 70s, who has earned income.
Kind of gives you a 2-year window
Yeah,
there.
so
to
it's like,
maneuver.
okay, let's start
Yeah.
planning this exit strategy and how to minimize your taxes.
That's a good point.
I know this, heavy duty financial planning, it is yeoman's work. It's not, we'll do all the heavy lifting, but we have enough of you. What are your goals? What are your objectives? What are you trying to do? Who's the money for? When's it for? But I wouldn't make any big decisions on any of this without doing the math. Because the math is pretty surprising sometimes when you look at some of these.
And it's different for everyone.
Jump a second. Can you talk just a couple minutes about DFA and anything about DFA funds or organizations? You guys, have been pretty successful with
Right.
Yeah, if the question is, do we still have confidence in them? If we order something from DFA, it's kind of like going and getting ice cream. If we order vanilla, we're going to get vanilla. If we order chocolate, we're going to get chocolate. If we order emerging markets, crappy as they were 2 years ago, that's what we're going to get. If we order large growth, you go look at that position in your statement, the large growth profitability fund, shop the lights out that. More importantly, since 2012, they've lowered fees 4 times, and so they're always looking out for the individual investor. We know the people, they're full of some of the brightest academics around, a lot of Nobel Prize winners from their investment policy committee. It's kind of humbling to go there because they all kind of look like, Olympic athletes. They're real thin here and big here, and they are like, literally like rocket scientists and Nobel Prize winners. But I don't know. I think they've done a really great job. You've noticed on the bond side, we do use some other low-cost options from Vanguard. But I tell you, the biggest bond position we have is a DFA Global Fund, and that just killed it last year. And I think that's because they're just perhaps a little bit more creative than Vanguard. And they're the smartest financial minds that I know of that rely on the academic research. They don't go making bets, and that's what we like about them. But they're not gonna, you're never gonna see Dimensional, I don't think, develop a fund that says these are the top 10 stocks that we're gonna target for next year. That's just not. There's not enough academic literature to support that strategy.
Another good thing was, I don't know if he said it, I couldn't hear, but they decreased the expenses on a lot of the funds last year too, or this year too. So a lot of the funds you use, the cost went down. So we pay attention to that, and that was, again, that's just more return in your pocket.
Both DFA and Vanguard lower their expense ratios.
Yeah. Good question. What else?
Fred, talking about non-spousal distributions of your assets. Let's say you die and your spouse dies. Typically, it's going to be your kids or grandkids that get those assets. Let's say you have an AD trust or a revocable trust, and you talked about death of the stretch. Is there a connection between having one of those trusts and the tax advantages there about the kids get it without, a lot of times without tax consequences? Can you talk about that?
No.
If I may, I think I like
Yeah.
Yeah.
Typically, and in all honesty, I need to go back and look at here in Susie's case, but we're not a big fan of leaving IRA assets to a trust for a lot of reasons, but a common sense reason I think everybody can latch on to. Your money's at TD Ameritrade right now. It's a big company, and it's going to get twice as big or more than twice as big with Schwab. So when they go and you and Susie pass away, and then here's this big bundle of money, that if they send it to the wrong place, somebody's going to pay for that.
So they're not going to send it out right away. So you're going to have to send your trust into, let's say, Schwab now. You guys are going to stick around a good long while. Anyway, right?
That's what happened.
That's the plan. So that's going to go to the Schwab legal department. They're going to be, fumbling through some 30-page trust document, and they're going, well, God, I don't know. We haven't really decided clearly. So the point is that the beneficiary designation document is really your estate plan, and it probably will never go through, through the trust. But moreover, if you have a revocable trust don't save a penny in taxes. I mean, I know there's a lot of myths about that, and I know that some attorneys may be a little bit aggressive in their marketing. But if it's a revocable trust, you've got the right to change your mind. That's never going to save you 1 penny in income or estate taxes or capital gain taxes or anything. Now, if we got into an irrevocable trust, it could, but I don't think that IRA beneficiary planning, I don't think you're going to get anywhere by funneling it through a revocable trust.
What else? Okay. All right. Thank you, everyone.
Thank you guys.
Appreciate you coming.
I know that you took it out.